This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning Andrew Joseph, who is no stranger to our Trigger Webzine subscribers. Andrew is principal of Golden Phi. He's the publisher of Triggers Media Publications, Inc., and the editor of the Triggers Webzine and website. Good morning, Andrew.
Good morning, Gordon. Thank you for having me back. It's great to be here.
I would ask our listeners to open the slides to full screen viewing. You need to open the slides to the full screen viewing to see the detail that we'll be discussing. There's an icon at the bottom right corner that by clicking it will allow you to do that. There is a box below the slides where you can make comments or ask questions, and hopefully when we have Andrew back later this week or in the future that we can answer some of those questions. I also need to be very clear that the slides that we'll be showing today are for educational and discussion purposes only. They are not to be used for trading, nor are they in any way investment advice. They are solely for discussion purposes. Andrew, I have up your very first chart, and can I ask you to take us through it?
Sure. This is actually a continuation from the last time that we were talking. We were watching the market, the SPX here. I'm showing, and we had S on the chart that you're seeing as a target that we were watching for the market to come down to and bounce off of. This actually is one of the one of the misses, not the first. This will be the third miss that we've had on high probability targets for the SPX. Across the board, 7 markets, we've actually made 177 of these calls, and only 14 have missed. And I know that sounds pretty incredible, but it's what's going on. And I encourage anyone to sign up for a free trial and look at what we're doing for themselves. So again, I wanted to bring this and show that this is one of the misses that we had, and the market did move down to S as we were looking for, but it didn't actually hit it, so we had to call that a miss. What's interesting is the timing on this, that although the price doesn't make it, soon after this, the S that we're looking for bounce off, although it doesn't reach it in price, in time-wise, it starts to move up after this, which we'll see in the next chart.
Andrew, I'd jump in and speculate on why the miss. What we're in is a transition now from risk on to risk off, and this is a period that I refer to as the volatility shift that happens during it. Now, I'm not talking about necessarily volatility just measured by classic measurements such as the VIX, because even it will lag as risk is repriced in. But what I mean is the various markets themselves, currency markets, commodity markets, equity markets, yield markets, credit markets, are all starting to shift, and they are in fact because as they are absorbing quantitative easing, unlimited QE3, and OMT from Europe, they're digesting right now exactly how much price is built into the market. And frankly, it's about 11 months forward. And then they're looking at the earnings and the earnings rate that they're dropping off, and they're doing net present value and translating that, and especially as we now go into the earnings season, because we've had a lot of the earnings warnings that have been steadily coming out for the last 3 weeks very quietly. And if they haven't been warnings, they've been adjustments that the analysts have been making that people don't see, because then they come in and they say they met estimates, but the estimate's been taken down in the last 3 weeks.
Exactly.
And unless you're on top of it, and that's our job, you don't witness it, and we see it. It's a game. So, but
exactly.
that starts to show up in the charts, and so at this stage, technically, it's very, very difficult to be right on. So I'm not at all surprised that some of your targets, as accurate as you've been, would start to slip in here, because there's no way of predicting it, because there's no consistency. The best policy, Andrew, at this stage is what I call, it's a high risk entry exit, and you go net neutral. And this is the time that you stand aside and you let the market, you change your trading strategy in this period of time. That's not to say that we may not have another significant lift up, But as you'll start to see that, and it'll become quite clear.
So as you can see, we just missed on the S. It did not come down as far as we were hoping. It found support on the lower Bollinger Band there that we have. We were expecting a move up through, though, a lift through P and then up to N eventually. And if we look to the next chart, this is the following week, and we see that's exactly what happened. It moved up to where P was, and it comes right underneath N. If you take a look at the inlay, I put that in because we were starting to get near some really significant lines and triggers coming around here and trying to decide where the bounce is and what's going to be most effective, what's probably going to hold the market. If you look at the inlay, you can see the red line, which is on the larger chart, comes from a top, and this goes way back, 2008 kind of. If you look at the blue line, you can see that's coming right actually down from the bottom of the 2009. The green line again is has been a channel line or a trend line that shows where we almost are at. You can see how far back again that goes, and that was kind of the point of the inlay. All of this again is to say is that I wanted you to take a look at the shape from the bottom of 2009, because that's the line that's between N and Z on the larger target there. It's not marked, it's just a gray line, but that's actually the ellipse edge that we've been following since the bottom of 2009. And it's not shown as a target, but it's mentioned as a probable overshoot on target N should we get that. And if we look to the next chart, that's pretty much what happened. We got an overshoot and stopped at this ellipse, and it's found and maintained support resistance there to date, actually. That's where it ended up bouncing off of, and we've had some support. Looking from there, I was expecting another bounce back down to X. And this is, if we go to the next chart, boom, again, that's exactly what happened. And this is as of September 27th. I wanted to show again how things were progressing, where we've left off from last month. And as you can see, we had a few more targets. One kind of missed, but the next few hit. From here, we're looking for either a bounce, or if the market breaks through all of these, we can see the next sites in target. Part of the methodology goes exactly to what you were discussing, Gordon, is that you don't really know at times where the market's going to head. And one of the things that we're doing here is providing targets above and below the market. And the point of this is that, so if the market does go up, then this is where it's most likely going to go. And if the market decides to go down, then this is where it's most likely going to go on the downside. Between these, there's technical triggers. And these are all set up, as you can see on the charts, all these lines in the different Bollinger Bands. I guess it's easy for me to read because I've created it, but when people start looking at the charts after a little while, they can see all the different technical tools that are in there. And as you go over them, toward either up or down, you can decide whether it's now the right choice for you to go to that target. Again, part of the methodology is to provide above and below, because we're wrong sometimes. I always have a bias, but we don't always know exactly, and there's always surprises in the market. So when the surprises come, you follow the technical triggers, and it'll get you in on the right side towards the target. As a methodology, you might say, well, how do you know it's going to reach the target? All I can say is offer the proof of concept that we've been doing all summer. And like I said, we've had 177 of these forecasts across 7 different markets, from the SPX, the US dollar, the VIX, the gold, oil, a couple different currency crosses. Of these 177, I've had 163 hit. 14 have missed. So that's a pretty good percentage there. And if you follow the methodology, you should be able to get these kind of results yourself.
Yeah, Andrew, the core reason here that it works is on the negative side, you can never tell exactly which way the market's going to translate something in going up or down. But what you do know, so you don't know how it will break. You can have a very strong bias, and you can be fairly accurate, pretty good. I would say better than 50% of the time of calling which way it'll go. But I very seldom found that you can get much higher than, let's say, 60-65%, which you can make money at, but you don't make any really good money at it. What you do know is once it makes its move, you can nail what it'll go to, whether it's going up or down, what point or high probability target it'll reach. And why that is because all of the computers en masse, once it starts to make its move, once it's triggered, they're all going to settle at a certain point, because that's where all the methodologies start to center themselves. Whether you're into GON, whether you're into Elliott Wave, whether you're into channels, Fibonacci's, all of these are working together, and like a magnet will draw to these points. Now the key is one, knowing what they're going to identify, what the points are going to be, as you clearly point out, and you've been very accurate on. But the other is to know when the trigger actually occurs, and that is it's made its move and is going to begin to move to one of these zone areas. And that's the real key. And it's not difficult actually to know that, because you can see whether it's in a holding pattern, it hasn't made its move, but once it makes its move, you have lots of time to get in. There's no shortage of time to make. The moves are usually multi-days, multi-weeks, and you can get in and enter into those points. Would you agree with that?
100%, Gordon. A lot of times you'll find that, for example, if we look at the current chart between X and T, we have two support and resistance lines there. They're both blue, as you can see on the chart. Should X, prior to breaking up and over, we were looking at what was going to happen, and then the market itself was range bound between X and T, and it happened to break up and move up to the next level. Had it broken down, it most likely would have come down to the next level there. These levels are very easy to see. The market seems to move in between them, up and down, and then when it decides which way it's going, it moves to the next level, and then it'll stay there and consolidate for a while, and then move to the next level, up and down again. And these levels are very easy to see, and they go back in time, years actually, with your trend lines and channels and such. You can identify them. And the SPX, we have some of these going back to 2000, and they're still in effect, and the market still respects them when it gets to them.
Why I like your system so much is, in many ways, I've been doing the same thing, but I do it on a monthly, weekly charts, and I've said for years, I can't tell you how the market will get there, but I can tell you where it's going to end up. And more times, very seldom does it not end up where we believe it's going to end up. Maybe the time is a little bit off, but how it gets there, boy, the pattern is almost impossible to know in probabilities. But that's at a weekly and a monthly chart. Now, you've taken them down from daily and hourly charts and taken the same pattern, same methodology, and same triggers, whether they're our GMT triggers, they're our macro or our market triggers, and been able to translate it. So what's happening is your high probability zone targets. That's why you're just nailing them. Do you want to show the listeners some of those results, Andrew?
Sure. I think I brought them. If you take a look at the next chart, I showed up what we've been doing, and this is from July to September 28th, and you can see the number of calls that have been made for each market and the markets that we're calling from. Specifically, the SPX that we've just been looking at. We've made 20 calls since July, and 17 have hit, 3 have missed. And again, you can look through. Gold is another one we're following. I've made 26 of these high probability target zone calls on gold. 24 of them have hit, and I've missed 2. So I don't know if that's helpful to somebody or not, but it's very rare that I can't find this anywhere else that I'm looking around online and people being this accurately. I'm sure there are some people that are doing things similar, but I'm actually really still surprised at how well this is turning out. I knew we had something going here, but I didn't realize how good it was until I actually started doing some of this recording of the statistics. And
Andrew, what our listeners are getting is a peek into how the big institutions, the very large investment banks, why they do not have a trading loss day, but it's proprietary, and they don't sell it, and they tie it all together. And as a matter of fact, their odds of winning are higher than a casino's right now. And just check their 10Qs and 10Ks, and you'll see that. And what you're doing is exactly in a microcosm what they do, but don't sell it and don't open it up to the public. It's part of what they refer to as a prop desk. And that's why you're relatively accurate here. Very accurate, matter of fact. And there's a reason for it. I'd ask you to explain to our listeners, you're doing this on a multitude of markets, not just the SPX.
Exactly. As you can see from the charts there, we've got the SPX, the US dollar, a couple currency crosses on the VIX, the gold, and oil.
The listeners could choose the market they're interested in or all the markets as part of your service?
Yeah, we have different subscription levels that they can come and take a look at. The basic plan that gives you website access comes with updates for the SPX, and those are twice a week. And then if they're interested in more currency or commodities, they can sign up again to receive those inter-issue updates as well with the high probability target zones.
On your website, you have descriptions and more information on this trading methodology?
Yeah, one of the things I'm trying to do actually is bring this out and use it as education. And what I'm doing here really isn't that difficult, and I think I can teach it to other people. And I think there's value here for other people learning this, and they can then apply their own strategy to this, knowing where the market's going to move. They can decide then how they want to trade that. That's pretty much what's going on here with our inter-issue updates. I don't want to mislead people and think this is a trading service. This is not a trading service. I'm providing technical analysis, and I'm showing you where I believe the market's going to move to, and I've been pretty accurate on that. And then it's up to the traders themselves to decide how they want to trade that and get to those targets when the markets move.
Because that's very dependent on your risk profile.
Exactly. Everybody's each individual's different.
Yes. And so that's something that you need to decide on. You and your financial advisor needs to look at it, what term you look at, whether you can watch the markets close enough that you're in a very short term, or you're a swing trader, or you're a position trader, but you're just giving another input as another consideration for their investment strategy.
Yeah, and regardless of their style, whether they are doing swing trading or they're doing day trading, or even they're just a long-term investing, this can show them where the market is moving to and what we believe is going on, both in the short term, because I'm doing hourly charts, as well as in the longer term with the daily, and on the site we put weekly and monthly charts that I don't in the updates. Those are just open for anybody who has access to the website can go and see these markets and more, what we have for longer-term views. And again, depending on the trading style, they use it however they want.
Most of my subscribers, Andrew, are not traders. They're long-term investors or minimally trend following. So they're taking the long term. And where this is really powerful is giving them good entry and exit points, so that once they've made the decision that, in fact, the market's in the final throes, and, I advise very strongly not to try and take the last 3 or 5% of a market out of the top or the bottom, because it's the most expensive part of the market. But once you've made the decision, it's time to go neutral or the time to go long, short. This would give you a very good way of then making the decision to assist in time to enter.
Exactly, yes.
So it's just another input and another tool as part of a full product service. Andrew, we're up against a hard line. I really did want to take the time today to allow our listeners to see the work you're doing, to know that there's trials that they can sign up for, that they can also follow your webzine magazine, which is just an outstanding document, which is part of the service or can be viewed separately. Could you tell our listeners how they could get a hold of you and learn more about your services and where they would go?
Yeah, they can come to our site at triggers.ca. And contact me at goldenpie@triggers.ca directly if they like. We have a trial view. The last 3 full issues are up for review from this past summer that we've put up if they haven't seen those yet. And then again, they can sign up for a two-week trial of these inter-issue updates, in which I give them, they would receive 4 updates throughout the week for 2 weeks on all the markets that you can see on the screen here now.
Well, we're going to be doing this on a monthly basis, as we have been and will continue to do. So the proof will be in the pudding, Andrew, as we work through this. And each month we'll try and revisit some of this, but also revisit different markets as we look at the different interplays and tie it into our drivers that we discussed in our last session. Any final comments before we break?
Thank you very much, Gordon. It's been great working with you here.
Looking forward to next month.
Me too.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.